Thank you for having me here today. As Per was saying, my name is Javiera Ragnartz, and I'm heading the investment department at AMF. And the panel is about these two questions, as I understand it. And we did answer through the iPhones, but if I were to answer those questions spontaneously, I would say that can sustainability generate outperformance in the public market? I would love to say yes. This is what I would like to believe. And if not, should investor pursue it anyway? I would like to say no to that question. And I'm going to talk about the investment process that we have at AMF, and hopefully give you an answer to why I'm answering these questions this way. But first, just a brief background on AMF. As Alecta, AMF is a mutually owned company providing predefined occupational pension to primarily blue-collar workers. So our clients are not the people in Sweden with the highest income, rather the opposite. We do have about 4 million customers. We manage around 600 billion Swedish crowns, which 120 of them are in mutual funds, because we also have a fund company within AMF. And our goal or our mission is to try to create the highest return as possible, but we are also a long-term investor. So we are to provide a long-term sustainable return in order to be able to provide good and stable pensions to our clients. And how do we work with the ESG issues? We have a holistic approach to sustainability. And that is because we do believe that companies that apply a sustainable approach in their business will have a higher probability in the long term to provide higher returns. So as Magnus was stating, this is much about the time horizons you have in your investment process. And as a pension fund, we do have a very, very long time horizons. And I don't know if I am to get into why we think this is why the sustainability will also mean that the market can outperform. There are several reasons, and I think, Laura, you were talking to some of them. There are several risks that are diminished if you are to focus on these kind of issues. We do believe that society's commitment to sustainability has increased, and it will continue to increase. We do also see increased regulations. I think Magnus just talked a bit about the regulations that might be coming. And companies that are early in adapting their business model to the regulations that are coming will have an early mover advantage. We do also believe that companies that have a good sustainability approach also have a better way to analyze not only their own effects on the environment, for instance, but they can also analyze what environmental changes that we are seeing at the moment, how they will affect their business in the future. We do focus on the ESG more generally, not only on the E. We experience that a lot of the media and a lot of the debate at the moment is only about the E. We think the S and the G are equally important. And this is very anecdotal, and it's only our experience, but we do experience that companies that have a very good governance management will also have a high and good level of social and of environmental and social policy. So we think that the G leads the E and the S in a sense. Equally important is that we strive to integrate sustainability in all our investments. And this means that we do not really involve in impact investment if we, by impact investment, mean that we do investment because they are good from a sustainability perspective, on behalf of performance. We do not involve in that. And there are several reasons for that. One of the reasons is that we think that working with the entire portfolio will have a better effect on the environment, and so on. But also because we do not think that we have our clients' mandates to involve impact investments. We did a survey about 2 years ago where we asked our clients, and more than 50%, the majority of our clients answered that sustainability issues are very important to them, but not on expense of performance. So it's always performance first. And how do we do this? Well, we have a best-in-class approach in equities and fixed income. Equities and fixed incomes stands for the major part of the portfolio. We have more than 40% in equities and more than 30% in fixed income. And a best-in-class approach means that we invest in the 50% best companies from a sustainability point of view in each sector globally. We started this in the equity portfolio, and it has now moved on to the fixed income portfolio. This means that the portfolio managers, they get a universe to invest from that is only 50% of a global index, a global common index. If they want to do an investment outside that universe, they are to write an analysis of why they would like to do that, why that company is outside that universe, and they need to engage in a dialogue with that company to try to affect the company to do better in the issue that they're not doing great. We do have a quite big portfolio of alternatives, and in some sense this is easier for us to work with sustainability issues in that part of the portfolio because often we have direct ownership, which give us board positions, and we have direct access to the management of the company. But we do also have alternative investment through external managers in terms of external funds, for instance. That is much difficult for us because we do not have control in the same way as when we own an investment directly. Our aim is always to do direct investment in alternatives, mainly for two reasons. The first and most important reason, in a sense, is that we think that we will achieve a higher return by doing direct investment because the cost will be much lower, and we are very cost sensitive, just as Alecta. But that might be difficult to do that in a sense. So we do have other investment, but we like direct ownership better. The other reason to try to do direct ownership is that we have a better control of the underlying asset, and we have a board position, and we can affect the company more directly. And alternatives are very good in a sense if you think when we want to work with sustainability issues. Because, for instance, we like to, when we look at alternatives, we look for investment that are uncorrelated with the other assets that we have in the portfolio. So we look for assets that are not correlated with the equity market and that are not correlated with the fixed income market. One good example of that is infrastructure. We are looking for infrastructure investments, and when we look at those investments, we try to find investment that will generate a long-term good cash flow at a fairly low risk. And one of those investments that could have these characteristics is wind investments. So our alternative portfolio and the infrastructure part of that portfolio, that is around 2% of the entire portfolio, is wind at the moment. Our last investment that we did in this area was the acquisition of 35% of Stena Renewable, which is a Swedish firm engaging in land-based Swedish wind. So we like this kind of investment because we are doing a good investment for our clients at the same time as we are working for a better environment. And they go hand in hand. And this is what we always look for. We also believe that all our investments should be consistent with the Paris Agreement of limiting global warming. And the first step to do this was actually launching a fossil policy, which, among other things, states that we are not to invest in companies that have more than 10% of fossil fuel, abstraction of fossil fuel. So this is the way that we work with sustainability on an overall level. And we think we have come a very, very long way, but we do think that we have still a long way to go. And our vision is that sustainability should be a natural part of the investment process. And I don't think we're there. I think the market as a whole, the investment management universe is not really there. There are some exceptions, but a lot of people are buying, as we are doing. We are buying the sustainability analysis from external partners. We are buying from MSCI. There are other analysis firms that are called ethics or sustainalytics, whatever you might call them. So the asset managers are taking the analysis on sustainable issues for granted. They are not doing them themselves. This is not the way they're working with the financial analysis of the firm. Because when they work with the financial analysis of the firm, they might get analysis, external analysis as well, but they will always have their own view on that. And to integrate these issues completely, we need to fill this gap that we have between the sustainability people at the firms and the asset managers. So the day that we do not talk about sustainability issues, I think our vision should be that we will not sit in this conference talking about this, because sustainability issues are going to be a factor as anything else, as another financial factor, as talking about cash flows. I think that is what we need to strive for, because when we reach that point, we will have an effect on the environment and other issues that we are aiming at. When it comes to how to involve, Magnus talked a little bit about that, and I can mention something else, is that we have different ability to engage in different asset classes. If we take the Swedish stock markets, we are a big owner in the Swedish stock markets, which give us a seat on not on the board, but on I lost the name, on nominations committee. Thank you. We have for a long time, together with our peers, Aselecta and others, worked for through the nomination committee to work for more equal, gender equal boards. And through the years, we have seen some achievement in that sense. When it comes to the Swedish market, we can have a better dialogue with firms. We can have direct access to management, something we find a little bit harder when it comes to the global market. So we do have different ways of working when it comes to the portfolio. Well, I think this is all I wanted to say at the moment. Thank you.